So if you all understood everything that's been said over the last hour, you're a lot cleverer than me. I don't know much about emerging markets, and I know, actually, I was slightly involved in the oil industry in the past in Aberdeen in a previous business, only in the service side of it. But this is a vastly simpler proposition, I think, possibly not as remunerative. I'll leave you to judge that, in that we have set out to create long, stable dividend income for our investors based on modern purpose-built real estate. So we're a FTSE 250 business. I launched it on the main market in March 13, and 13 fundraisers later, we have just over 900 million of real estate in 94 or 95 care homes, and we are paid quarterly rental from each one of the homes. You'll see how profitable the sector is as we go through the presentation, and from the rents we pay some costs and pay out a quarterly dividend. So there'll be a quick introduction. I'm going to speak about it's an externally managed fund, so I'll speak about that. Then the REIT itself. I think it's helpful for you to understand the care sector and what's going on within the care sector. As I look round the room, there are a fair number of people who are a bit like me and probably should be retired. But I love what I do and plan to carry on doing it for a fair while yet. So I'll speak a bit about the care sector. There's going to be loads of people going into care homes in the next 20 years. Speak about the performance of the portfolio and the financial performance. Yes, I agree. It is quite important. I was sitting at the front, so I don't know who actually said it, but yes, I'm a chartered accountant, so I do like to see the numbers. And in truth, for every one of our care homes, we see every month the financial performance of each one of our care homes, so that we have a really good understanding as to whether we're likely to receive the rent. So we're a specialist manager. We claim, I think reasonably, that we're the leading UK specialist healthcare property fund manager. We're certainly the longest serving together. Myself and some colleagues started this up 15 years ago. I've been involved in healthcare for over 20 years. So starting 15 years ago, we have a strong track record of successfully investing. This is only what we do. We've got a great ESG story, and we have all of the regulatory stuff that is appropriate. As a manager, we have more than 100 care homes. We actually started with an unlisted fund. That fund finally closed in late 21, 22, and a UK pension fund asked us to allocate money to invest money on their behalf. So today we have two funds, the listed strategy and the unlisted strategy, and we're a team of 34 people. And the original 4 of us who started it are still together 15 years later, believe it or not. So that maybe tells you something. Most of the investment team joined us 12 years ago, and they're all still there. We love what we do. We're passionate about providing good care homes for our seniors. So what is Target Healthcare REIT today? 94 homes, 6,500 beds, 61 million of contracted rent. As I said, the portfolio value are just in excess of 900 million, and it's currently valued at about 6.2%. We have a multiplicity of income sources. We don't want to be, a number of you here, I'm sure, are old enough to remember Southern Cross, which was a complete disaster as a care home invested in the listed markets. We actually launched this in the demise of Southern Cross. And one of the things we said to investors back then was we will be highly diversified. And when I say we're highly diversified today, the largest tenant only provides 16-17% of our income, and then there's 4 or 5 at about 5 to 8%, and then there's another 28, 29 who are 0 to 5%. So a really diversified income source. As I say, we founded the thing in 2013, and we're a FTSE 250 business. And we believe we're differentiated by quality, modernity, and ESG compliance from many in the sector. This is going to be slightly indelicate. I'm not sure you're not, I'm glad you're not got your food, but continence is a massive issue as some of us age. And continence management is essential within a care home. About 70% of the residents in a care home are singly or doubly incontinent. We go back to being babies, guys and ladies. And if any of you are parents, you know that you have changed many a nappy or a diaper. And that is the reality of 70% of the residents in a care home. So do you want that as a resident to be done in the privacy of your own bedroom with an ensuite wet room? Or do you want to join a queue of 8 or 9 people in the morning going into a common bathroom? Need I say more? 100% of our rooms effectively are wet rooms, our bedrooms. We think we're the only portfolio in the UK that's 100% EPC A and B rated. Only commercial real estate portfolio in the UK, we think. All of our underlying leases have inflation-linked rental uplifts, apart from one. And today we have 26 years of income. The previous speaker was speaking about a 20-year runoff of his gas. We have a 26 years of income on average from our leases, and the leases typically rise with collars and caps in line with RPI, and the collars and caps are typically 2 and 4%. And the physical real estate is way ahead of sector norms. You'll see Target Healthcare REIT here on the left. The listed peer average, the other listed peer in the UK, as you're probably all aware, is in the process of disappearing. But there is also some European real estate. And if you look at us compared to what's in England and Scotland, you want to be in the green stuff if you want to be part of modernity and the future. And we also think that wet rooms are really important. The other thing that people speak about, let me explain a couple of these things. That red bit is conversions, and often with no facilities. The sector has a bunch of stuff which they call ensuite, but the ensuite is a WC and a wash and basin, no ability to have a shower or a wash. So what do you do if you've got a dirty nappy with a baby? And don't tell me that wet wipes work, because as we're elderly, our skin is fragile. You need to give it a wash. So I said it was a little indelicate. If you hear me speaking, we get into, this is the reality of care homes. And as a real estate investor, we want to provide fabulous real estate for fabulous people who are providing care across the UK, and that's our business, to support them. And then I said EPC A and B rated. We're in a wonderful position, and it's all there. I won't tell you any more about that. So when we launched this on the public markets 12 years ago, what were we going to try and do? We're going to create really long-term income. We want it to be inflation-linked. We'll only invest in modern purpose-built care homes with ensuite wet rooms. We want highly diversified income because the sector has had often challenges. You'll have read about the sector in the Daily Mail or some of the rags, and actually, sadly, for good reason. You know, there's bits of really poor care. We said we would, however, in that context, be an engaged landlord. And what I mean by that is that we have 4 people who physically inspect all of our homes at least 2 or 3 times a year. I'll read half a dozen reports of the physical inspection of the homes on a weekly basis. And we also said we'd be highly focused on private pay. Believe it or not, I don't think the government has got a lot of money. And I think our dear government will run even bigger deficits. And the government has spoken for 20 years about how they're going to sort social pay. Do you remember Boris on the footsteps of number 10 when he came in? We are solving this. We don't think the government can afford to do it. We do know there is very significant net worth in the over 65s, 6.6 trillion of net worth. The UK has much more significant net worth in its seniors than the whole of Europe, every country in Europe, because it's largely a rental model in terms of domestic housing. In France, Germany, there's much more of that than there is here in the UK. So how have we done over the long term as a fund? Well, we've outperformed the MSCI annual healthcare property index every year since we started. I keep saying to the team, especially the investors who went and bought these things, stay humble, lads, to try and be sure that we continue this in the long term. But I'm thankful to say that we're number 2 in over the last 10 years for that index. There's about 9 billion of assets in the index. And for the last year, we were number 4. It's the long term that we're really keen. And you'll see in the last couple of years, we've outperformed quite significantly. There's a picture of one of the homes. Now, what are the tailwinds that back up this opportunity? Just under 13% of the over 85s require residential care, typically for the last 18 months of their lives. The number of over 85s is expected to double in the next 25 years. Double. And they have 6 trillion of net worth of the over 65s. So there is a compelling tailwind for what we're doing. And do you want to go to a rubbishy old care home with smelly corridors, with smells all over it? I'm sure I'm seeing 1 or 2 smiles around the place. How many of you have been in care homes, old care homes? Yeah. Were they pleasant experiences? No, sadly that's the case. Come into our care home in Dartford, go into our care home in Bicester, go into our homes in Newcastle, go into our home in Arbroath or Huntly or Glasgow or Edinburgh or, they're all, we have a whole bunch of them. You'd be very pleasantly surprised at what they are. And has the preponderance of wet rooms increased or not? So when I started the idea of creating a fund like this in 2008-9, about 8% of the beds, of the bedrooms in the care home had wet rooms. When we launched this fund in 2013-14, 14% of the beds had wet rooms. And last year, 34% of the beds have bedrooms. And you'll see on the last circle there that Target is in a little bit of a better situation with effectively 100% of the beds with wet rooms. And we also think that it's really important, because we are quite cynical about whether the government will ever solve this, that it's really important to be in the part of the market that has significant elements of private pay. And have a look at these slides. Through the pandemic, we were down to 62% of private pay, but then it started to grow, and currently just under 80% of the income that our tenants receive from their residents or their residents' family comes from private fee sources. That is radically different to most of the sector. Now, a little bit about resident occupancy. It's going down a little in the last quarter. That's what we usually see in the last quarter. The most important thing for us as we look at our tenants is this one, is our rent that we receive well covered by the profits of the homes? And you'll see that we're up at 1.9 times covered. So if the home is making £100, the rent is 55 or 60 pounds. 50 times 1.9 comes to 90. So great rent cover. We actually do all our underwriting based on them being 1.6 times covered. So we're a nice about 20% ahead of the cover that we originally wanted. And we think this is probably quite a useful slide too, because a number of people say, well, with inflation and national living wage and so on, can you be sure that you'll continue to be profitable? And the answer is, if you're in private pay, absolutely. If you added up the top line there, you would see that that comes to 45% is the average weekly increase over the last 5.5 years. If you added up the inflation rate, it's 34%. So the bad news, if you're an elderly person, is you're paying relatively more than inflation. The good news, if you're an investor in the sector, is that your rent is stable and you have a good long-time rent cover. And you'll see on the bottom line there, the rent cover used to be down at 1.5. Through the pandemic, it was remarkably stable, and it's grown to 1.9 times. A little bit about the financial performance. For the 6 months to December 24, just under 30 million of income. The EPRA earnings, 19.4 million. EPRA earnings per share of 3.13 pence and dividend paid 2.94 pence. So a dividend cover of 107% and accounting total return for the 6 months of 4.5%. The rent has moved in line with this chart here. You'll see in June 2024, just under 59 million of income. As I said, we get annual uplifts in our rent, and these annual uplifts came to a total of 800,000. And then we completed some developments, which created a further 900,000 of rent, and other little bits and pieces, some investment in solar panels and things that were capitalized, coming to a total rent roll at the end of the year of 60.6 million. We have a very simple balance sheet, really. We own 925 million of assets, 94 assets, and we have some debt, which a significant portion of which is very long term. The Phoenix debt you see there has two maturity dates, 87 million in January 32 and 63 million in January 37. Total cost of debt, including the amortization of the costs of obtaining the debt, 3.3%, and then some shorter term facilities from both RBS and HSBC, which mature in November this year, and we already have offers of refinancing of these at really quite much tighter margins, interestingly. So we're in a really good place in terms of the debt summary. So who are we? I speak to you as the founder of this, both the fund manager and the guy who met every investor for the last 12 years, 13 times 50 meetings. Has been a bit of fun over the period. We think we're the leading UK specialist healthcare property fund manager. I'm thankful to say, I remember when we started this 15 years ago, a property guy saying to us, you know, Kenneth, this is all very well. It sounds great, and I hope it is great, but it's 10 years on that we'll know if this really works or not. And I'm thankful that today we have a 15-year track record. This is what we do. We invest in modern purpose-built care homes. We know more about this sector than many, if not. Care England's data people came to us and said, oh my goodness, you know an awful lot about the sector, more than we know ourselves, and they're the owner's representative, the operator's representative. We perform well based on the share price at March 25. The share price has gone up a little bit since then. It was 91.8 then, and I think we're at 97 or 98 at the moment. The current dividend yield at that stage was 6.4 and a decent dividend cover. So that is my story. And thank you very much for listening.
Thank you very much indeed for the presentation. If you have any questions, please raise your hand. One here, please, Chris. Thank you.
Hi, thanks very much for the presentation. I think you trade on about 12% discount to NAV. And I read that care homes is a sector that private equity like very much, and in fact have invested a lot in this sector over the last few years. Is it a concern of yours that you might be subject to a takeover at some point because of the discount? I mean, lots of others have been, haven't they, in other sectors?
Yeah, I've spent the last 2 days at a Peel Hunt real estate conference, and I probably listened to 15 CEOs of REITs. And as they were all speaking, I walk in feeling bad about a 12% discount. And as I was listening, I was getting my phone out and looking at them saying, my goodness, he's at 25% discount. He's at 30% discount. So it is the reality of the sector we're in. And our job is to do this really well. And
a very attractive asset.
Yeah, that's right. And that's what we do. And that's our focus.
A question towards the back, please. Just a quickie whilst the microphone's going over. The properties in the portfolio, are they built for you, or do you acquire them once they've been built by developers?
It's a mixture of what we've done. We have bought about 25 of them with forward funds, another few with forward commits where we've bought it as it opened, and that leaves 65 or 70 where we have bought assets that are already operational. So it's a mixture, but always with wet rooms. Probably about 250 of the beds didn't have wet rooms when we bought them, but when we were buying them, we were saying, can we fit a wet room in here? Can we make this work? And what can it cost? And that's why there's 15 or 20 beds left that haven't quite been finished. But
thank you. Roughly what percentage would you say of the gains, investment gains, are from property related? So if the property prices of the care homes go up or down, and also if the residents are paying for the care through equity release, for example, and what percentage would you say comes from the care services being provided?
So the dividend we pay it comes entirely from the rental stream. Yeah. The total return aspect is partially from the uplift in the value of the property, and then for the resident in the care home, we don't have total visibility about how they're paying because they're not our residents. We speak of them, but they're the residents of the operators. But it's always a complete mix because we have family. All of us here have probably funded this in one way or another. It's a mix of equity that have been left, sometimes housing net worth, sometimes pensions. It's a complete mixture.
Thanks.
And typically when a resident comes into a home, the care home, a good private care home will ask for evidence of the ability of the family or the resident to pay 2 years of fees. And the fees are paid in advance in care homes.
Did that answer the question? Sorry, did that answer the question?
Sort of.
I think you were asking, so for the share price for what component or what percentage of the share price is property portfolio valuation? And
NAV.
What is
the previous question, NAV is 112 and share price is 98, 99. So so we trade at a discount, if that is one way to answer
But the
your
NAV
question.
is calculated by the value of the properties.
The NAV is the value, is property value
Yeah.
valued quarterly by an independent valuer in the
Lovely.
light of market conditions.
Okay, thank you. Yes, please.
With the discount that you've got at the moment, obviously expansion is probably going to have to be funded by debt. Do you have a feel for how high you would be happy with your gearing going?
Yep, we want to be a conservative product. So you want, we've never been higher than 28%, we're currently 22%. So we have set out to be a long, boring, stable income fund. We're the complete opposite of Touchstone. Actually, the complete opposite of, I don't remember the name of the first one. But we're just really, really different. We're a long, boring income fund. I have done exciting things in my earlier life, and I decided at this stage of my life I would create long, boring, stable income.
The next question I had was about, you mentioned you've been at the Peel Hunt property conference. I'm sure there was also M&A in the listed real estate sector. And you mentioned the only other fund that looked like you was on the way out. Would there be M&A opportunity for you? I imagine that would be dictated by the quality of the properties available as well as the companies being available. Can you
There's
talk
no
about that?
listed real estate fund for us to acquire, which is, there isn't a UK listed real estate fund to acquire. We would not acquire the fund that has just been bought because 80% of its bedrooms did not have wet rooms.
Yeah.
So we firmly believe, what do you guys want to be in? Do you want to get your bottom wiped in the privacy of your own bedroom, or do you want to use a common bathroom? It's an abomination what we have across the sector, and we will not be part of that.
I can vote for that.
Yeah. Yeah, so that's the bottom line for us. We won't touch that stuff. That stuff needs to leave the market. Speak about responsible investing. Do to others what you'd like to do to yourselves. I want to be in one of our homes, not that stuff. I know the smells in some of these things.
Any other final questions? Oh, sorry, we'll bring the microphone over.
Thank you. Yes, interesting presentation. On that last note, what's your approach to your due diligence on your operators? I mean, clearly you're doing due diligence on their financials and their ability to continue to yield rent, but what level of due diligence do you also do on the quality of healthcare that they provide or the quality of aged care that they provide?
I was going to say just now 150 man years, but the two ladies who are part of the team, there are 4 people physically inspecting the home, would lynch me if I called them man years. So 150 man-lady years of experience of people who have run their own homes and physically inspect. And, they might look at 1 or 2 people here and say, have they got the right cardigan on? It doesn't look as if it fits them well. And he hasn't had his hair done. I'm not looking at you particularly. And it is absolute revelation to go with them to it. Honestly, it is an absolute revelation to go with them because these are highly experienced people. And I've gone to care homes in my early days with Andrew and Billy and Karen and Tracy. And I came out saying, that was quite a good home, wasn't it? And they said, what? Didn't you see that lady in the corner? She wasn't properly looked after today. So very much on that. And that's why we physically inspect. And if we have a concern, we'll be in a home 6 times a year. We're pretty passionate about all that kind of stuff. I hope that comes across. But
I think it does. Thank you very much indeed for joining us
Pleasure.
this evening. Thanks for the presentation. Really good.